Is we try and do a short form report which gives succinct information that will enable the investor to very quickly understand the key assumptions we've used in the reserves, because as you can imagine, this is all input driven. Depending on the input parameters you use, you're going to get a different result. The other thing we do is we actually do a presentation to the market when we finalize our annual reserves and resources, and we actually explain again the methodology we've deployed in determining these reserves and resources, and also the key changes that have taken place during the year, and also some of the initiatives we're doing to protect those ore bodies. And these ore bodies, of course, will only exist if they continue to be economic. So it's very important for us to make sure that we can continue to drive economic improvements in our operations.
We also need to appreciate that gold production has been declining for the past 5 years. Do you think that that trend is going to change, or do you think it's literally a function of the fact that gold mining in South Africa is getting deeper and far more dangerous?
Well, I would say that a company like Gold Fields still has a very substantial reserve and resource base, and if you analyse the numbers for last year, you'll see that out of a total of 81 million ounces of gold reserves, around about 2/3 of those are in South Africa, and that represents at least 20 years of production. So we have a much rosier picture than a lot of people would believe, and it's tantamount to our very strong reserve position that we've had and that we continue to protect. So I would say, although the industry at large has declined because of lower grades and rising costs, which have also impacted cut-offs or pay limits, we are still in a very strong position to be around for the next 20 years.
Nick, what do you say to those investors, and these are investors that I speak to on a day-to-day basis? They say, you know, stay away from the gold companies themselves, rather invest in the physical. What is your argument for investment in a company such as Gold Fields from an investment perspective? Well,
certainly I can understand the logic in certain investors preferring to buy the ETF, as you refer to it. And over the last 5 or 10 years, the gold industry has not generated the kind of real returns that the ETF has. And we're acutely aware of this in Gold Fields, and this helps us to shape our strategy going forward. And what we intend to provide shareholders is not only the exposure to the gold price, which is what the ETF provides, but also exposure to growth in earnings and cash flow. The problem with the ETF is it only provides a one-to-one relationship to the gold price. If we can do things well in the gold company, we provide not only that exposure, but we can provide exposure to increased earnings, increased cash flow. And if we can provide our investors with both, then we will lure away those investors who've strayed off into the ETF and bring them back into the gold equities.
We saw gold hitting an all-time high of $1,264.90 an ounce not too long ago. We have seen the gold price come down from those levels. We're sitting at around $1,180 an ounce at this point in time. You know, we saw a sovereign debt crisis playing out. We were worried about double-dip scenarios and, you know, defaults coming through from various European Union countries. Things seem to look far better. What are your prospects for that gold price, given the fact that we're still expecting quite a bit of currency depreciation because of stimulus in the US economy and quantitative easing and all of that? So there's so many things to take into consideration when looking at the yellow metal. What is your ultimate view?
Well, as you may know or may not know, I never give a definitive forecast on the gold price, but what I will share with you is some of the factors that could influence it either positively or negatively. And if you do a scorecard on the gold price, there are far more positive aspects still than negative. And some people would argue it's already run too far, it has to retrace. But the one thing you have to remember is that there's only around about 0.5 to 0.8% of total global funds under management invested in gold in any form, whether it's physical in ETFs, whether it's gold equities or what have you. So there's only been a trickle into gold. If you could just double that from where it is now, that would more than absorb all of the central bank holdings around the globe of some 35,000 tons of gold. So I think the gold price has still got potential to go a lot higher. A lot of the investors I see around the world, and I see a lot of them, are new investors in the gold space, wanting to learn about it, and have decided that gold has again regained its status and must be included in every portfolio. And for me, that is the most telling point about the prospects for the gold price.